Why do smart people lose money in the stock market? It is not because they don't know math. It is because they don't know their own brain. Investing is 10% strategy and 90% psychology. Your brain is wired to survive in the jungle, not to trade on Wall Street. It feels pain from losses twice as strongly as joy from gains. Today, I will show you the 5 invisible mental bugs that are sabotaging your wealth and how to fix them before your next trade. The trap, the jungle brain. Why our survival instincts cause us to panic sell at the bottom. The brain's survival wiring is built for fast responses to clear threats, not for riding out long-term growth. When prices fall, the jungle brain flips into a danger mode, wiring you to react as if a cliff edge has appeared. You feel urgency, even if your plan has you invested for the long haul. This trap makes panic sell decisions seem rational in the moment, especially at the bottom where pain feels deepest. The idea that markets are a one-way street only makes the impulse stronger. The pain switch is real and it lights up when losses sting. The brain treats a loss as a sharper hit than a gain feels like a light nudge, so the impulse is to shrink exposure rather than wait it out. The anchor drags attention to the most recent dip, pulling you toward exiting right now rather than staying the course. The herd amplifies the pull, as seeing others sell creates a social cue that exiting must be wise. A sudden headline or a chorus of worried voices can feel like decisive evidence, even when it isn't aligned with your plan. Simple rules help keep the jungle brain from taking over. Build a plan you can automate, so decisions happen without emotion. Set clear guidelines for handling volatility and stick to them, even when anxiety is loud. Use a check-in routine, pause, breathe, and ask whether the move is driven by fear or by a reasoned adjustment to your strategy. Create small, repeatable habits like a predetermined rebalance window or a default response to a defined price move, so actions become habit rather than reflex. Keep a mental checklist. Is this a data point I can learn from, or a signal to abandon my long-term goals? Think of your investments as a long journey, not a sprint. When fear rises, frame losses as information to study, not as immediate proof to bail out. The jungle brain can be trained to respect the plan by rewarding calm, deliberate decisions and dialing down urgency over time. Visualize the portfolio as a tool for your future, not a mirror of the latest nudge in the news. With patience and simple routines, the pull of panic can loosen, and the mind can stay aligned with a steady, considered path. Bias 1. Loss aversion. Why losing $100 hurts more than finding $100 feels good, the fear factor. Loss aversion is a well-documented bias in which losses loom larger than gains. People feel the sting of losing $100 far more than the thrill of gaining $100. The brain's pain switch fires more strongly when money is at stake, and the anchor you carry about your wealth shapes every decision you make. When this switch is on high alert, it's easy to react to a market wobble with reflex rather than reason. The result shows up in how we trade. We tend to sell winning positions too soon to lock in a gain, and we hold losing positions too long in hopes of avoiding a realized loss. The fear of seeing a portfolio fall can feel more urgent than the calmness of watching it rise over time. Picture a common, practical pattern. You buy a stock at $50. It climbs to $60, and the urge to lock in that $10 gain pushes you to sell. At the moment, the gain feels safe and satisfying. Then the stock keeps going up without you, and you're left with a quiet frustration about the missed opportunity. On the flip side, a position you bought at $45 slides to $30. The pain from that loss makes you hesitant to admit a mistake. You cling to the stock, hoping it will rebound to break even. Worse still if you tell yourself it's only a paper loss. In many cases, the initial fear of confirming a loss keeps you in the red longer than the logic of the investment would. The brain's natural impulse is not just about money, it's about preserving status in the herd. Fear stiffens the spine and greed adds a whisper of bravado to buy into the next hot rally. You might notice yourself wanting to buy after a stock has already moved up, driven by the idea that you missed out on a bigger gain. You may also notice you sell after a small dip in price, convinced the drop is the start of a bigger slide. The pain of a loss becomes a louder signal than the hope of a future gain. When this happens, a clear plan can quiet the reflexes and restore composure. To detach emotion from money, start with simple, repeatable rules. Create an if-then plan. If a position reaches a preset gain, consider taking partial profits rather than all at once. If a position drops to a defined loss, reassess with your investment thesis instead of reacting to the latest headline. Automate what you can, such as regular contributions or gradual rebalancing, so decisions aren't driven by a hot moment. Use diversification to limit the impact of any single loss, and size positions so that no one move stings too hard. Think of your portfolio as a structured system, not a diary of every feeling you had while watching the market. Another practical tool is to give your emotions a name and a timeout. The pain switch can be acknowledged without permission to drive action. Label the impulse, "This is fear talking," then pause for a deliberate breath and check your plan. The herd can tempt you to chase what others are doing, but your best move is often the move that aligns with your long-term goals, not the crowd's mood. Rehearse how you'll respond to common scenarios so the next time fear rises, you've already practiced the right reaction. In time, you'll find money feels less like a battlefield and more like a measurement of steady, patient progress. Bias 2. The FOMO trap, herd mentality. Buying Bitcoin just because your taxi driver did. Why following the crowd leads to the slaughterhouse. The FOMO trap is a real pressure point in modern markets. The herd speaks in whispers and roars at once, and the mind tends to listen. When prices rise and stories of rapid wealth circulate, people feel they must join before it's too late. One common impulse is buying Bitcoin just because your taxi driver did. This is not a verdict on the asset itself, but a test of your own decision process. The crowd's mood can feel like momentum you don't want to miss, so you act to avoid being left behind. The brain mistakes momentum for certainty. Social proof lights up the same circuits that reward success, and that feels comforting in a sea of unknowns. The urge to participate swells just as hesitation would slow you down. The anchor you rely on often isn't a careful analysis. It's a price or a moment you heard from others. You anchor to a fear of missing out rather than to a steady, personal plan. The pain switch, when activated by a quick downturn or a noisy alarm on your screen, makes losses feel personal and urgent. You want to escape that discomfort, so you leap toward the next perceived opportunity, not toward thoughtful allocation. To detach emotion from money, slow the impulse with clear rules. Create a framework you can walk through, even on a loud day. Decide in advance how much of your portfolio you're willing to allocate to speculative moves, and stick to it. Use dollar-cost averaging or set automatic contributions so you don't have to chase a moment. If you can't explain the why in a few sentences, you probably don't have a plan worth following. Keep the crowd in the background and your own goals in the foreground. When you feel the pull of the herd, step back and check whether your decision is anchored in personal values and a rational assessment, not in the fear of being left out. Practice discipline by testing ideas against a simple checklist. Is there a long-term rationale behind this, or is it a spark of hype? Does the position fit your risk tolerance, time horizon, and liquidity needs? If the answer feels rushed or emotional, delay the move. Build an everyday habit of reviewing positions with an objective lens. The insights will keep returning. The crowd refrains from judgment in the moment, but your future self will thank you for the restraint. The goal is not to silence ambition, but to guide it with a calm, steady map. The herd can be persuasive, but it does not have to steer your wealth. Bias 3. Confirmation bias. Only reading news that agrees with your investment, ignoring the warnings. Confirmation bias is a natural tilt in our thinking. The brain likes evidence that supports what we already believe about a stock or market. You scan headlines and analyses that confirm your bet and tune out warnings to the contrary. This creates a self-reinforcing loop, and the mind feels comfortable riding it. Take the moment you expect a stock to rise after a string of gains. The herd in your feed chants sunny forecasts and success stories. You lean into those voices, yet when a cautious piece appears you skim it and move on. The anchor begins to tug, reminding you of how certain you feel, and you pretend the doubt is noise. The bias keeps you in a position longer than logic would advise. Markets turn, and the pain switch in your chest clicks on as prices swing against you. You remember the wins and forget the warnings. The result is a plan that looks solid in your head but loses money in practice. Countering this bias can be simple in structure, even if it takes discipline. Create a small ritual. Force yourself to read at least one credible opposing view before you act. Build a short checklist that asks 2 questions your thesis can't answer yet. Note a devil's advocate brief in your file, written in plain language, so you can revisit it when emotions rise. Set a hard rule. You don't add to a position unless you can name 2 concrete red flags that would make you rethink the trade. In practice, you'll see how small frictions change the flow of decisions. The aim is to separate the signal from the noise, to keep greed out of the driver's seat and fear out of the wheel. Your mind can still see opportunity without surrendering to every chorus of the crowd. With steady routines, you build a steadier compass. The goal isn't perfect objectivity, but a clearer view that protects wealth and steadies nerves. Bias 4. The anchor effect. Why you hold onto a losing stock just to break even. The sunk cost of investing. The anchor effect is a cognitive bias that pulls investors toward holding onto a losing position because the purchase price acts as a fixed reference point. The brain treats that price as a compass, even when new information says the stock's prospects have changed. The reference point becomes the anchor, and it warps judgment. The herd, a natural tendency to copy others, can reinforce this by seeing peers hold on in hope of a rebound. The pain switch is triggered by regret when thinking of admitting a mistake, so the impulse is to wait for a turnaround to break even. The sunk cost of investing is the concept behind this, the idea that money already spent must be defended rather than allocated anew where it might work better. Holding to a losing stock to avoid realizing a loss sounds rational, but it's costly. You may cling to the belief that a rebound is just around the corner, especially if the price once climbed. When you bought at 100 and it sits at 60, the anchor to 100 keeps your mind anchored, and the fear of locking in a loss becomes a stronger driver than the facts about current value. The result is opportunity cost. Money tied up in a fading idea can't be used for more promising opportunities. A practical illustration: if you hold too long, you miss other investments that align with your long-term plan and risk tolerance. The more time passes, the more the chance of a bigger drawdown grows. Detaching emotion starts with clear, preset rules. Establish a price-based exit. Sell a position if it falls to a defined level, regardless of what you hope to recover. The simplest version is, I'm not averaging down unless this changes in a meaningful, sustainable way. Treat each trade as a separate decision, not a continuation of the last. Use mental accounting to keep outcomes distinct. Don't blend a loser with your winners in your mind. The pain switch can help you feel the sting of a loss now in order to prevent a larger one later, but the goal is to translate that sting into disciplined action, not paralysis. Regularly review positions with fresh information and avoid the trap of break-even thinking. Another practical move is to imagine exit as a win promise rather than a loss cut. If new data improves the outlook, you adjust accordingly. If not, you walk away. The anchor loses power when you anchor your decision to current fundamentals and a plan you designed beforehand. The herd is powerful, but you can choose to step aside and evaluate on your own terms. By training the mind to separate the price you paid from the price today, wealth becomes a series of deliberate choices rather than a series of emotional bets. It's not about ignoring loss, it's about not letting a past price dictate future risk. With patience, you can convert the anchor into a tool that reminds you to stay disciplined, not a leash that keeps you stuck. Bias 5. Overconfidence. Confusing a lucky bull market with your own genius. In investing, the brain tends to mistake favorable outcomes for personal mastery, especially when markets rise. Greed meets pattern. When prices climb across many assets, the mind starts to attribute every gain to skill, not luck. This is overconfidence in action. The herd adds its pressure, many voices echoing success stories, and the confident voice inside grows louder. The anchor keeps yesterday's wins in clear view. The pain switch stays off as profits accumulate, making risk feel distant until a sudden pullback exposes the illusion. Consider a trader who buys in a broad upswing and refuses to trim positions, chalking every move up to genius. The market keeps rising. They ride the wave, ignoring risk signals, believing a rare skill has unlocked the secret. Then a correction comes, and the losses sting, but the story stays intact in their mind. I was right before, why stop now? Detachment starts with a simple rule: separate the outcome from your identity. The anchor can be reset by writing a plan and sticking to it. Build in clear, repeatable habits that guard against impulse and pride. Use small, deliberate checks, a fixed rule to take profits at pre-decided levels, a cap on how much a single position can move you, and a policy to pause after a run of gains. The herd will still talk, but you can choose not to mimic every loud voice. The pain switch should be wired to punish costly mistakes, not missed opportunities, so losses hurt enough to discourage reckless bets without freezing you into inaction. In daily practice, keep a calm weather eye on your own thinking. See profits as signals, not trophies. Treat small losses as a normal cost of learning, not a personal failure. Diversify and automate where you can, so you're not tempted to chase the next bright idea with capital you can't spare. When you feel a surge of certainty, slow down and ask what would prove you wrong. If the answer is nothing, you're likely leaning on luck rather than strategy. Cultivating this mindset helps you separate skill from happenstance, and it makes money a steadier companion rather than a mirror of your ego. The solution: rules over emotions. How to build a boring system that makes you rich slowly. People tend to react to market moves with emotion, driven by fear and greed. The brain treats sudden price swings as signals to act. That impulse is exactly what a boring system aims to cut. Rules over emotions means fewer spur-of-the-moment bets and more steady progress. The core idea is simple: automate the dull parts, keep decisions small, and let time compound. Begin with a clear picture of your long-term goal, then lock in a few straightforward rules. Rule 1 is automatic contributions at regular intervals. Rule 2 is automatic rebalancing to a fixed target whenever drift appears. Rule 3 is a pausing mechanism that stops action when thoughts rise to a fever pitch. Set up your accounts so transfers run on autopilot, and use broad market vehicles that require little tweaking. Avoid daily checks. The aim is boring, not thrilling. If the mood in the market is loud, you still wait for the next scheduled date. The pain switch keeps you grounded when fear or greed spikes. When a sensational headline lands, the rule is to pause and log the emotional trigger rather than trade. The anchor lives in your daily practice. Remind yourself of the long arc and deny the impulse to chase the latest hype. Create a simple decision guide you can carry. One page, crisp rules, clear priorities. If you feel an urge to trade, read the guide, take a breath, and let the system do the work. A short diary entry about what you felt helps you notice patterns without judgment. Practically, this approach reduces friction and error while building consistency. You still learn, but at a pace aligned with reality, not with the drama of the moment. The boring system offers quiet power. It keeps you invested, disciplined, and prepared for compounding over years. You can adjust the rules as life changes, but only through a scheduled review, not on a whim. In the end, wealth arrives through steady repetition, not dazzling luck. The market transfers money from the impatient to the patient. Markets price assets through the ongoing tug of buyers and sellers reacting to news, expectations, and time. Momentum creates cycles. The patient investor stands to gain when the market climbs back after declines, while the impatient often sells too soon. When sharp moves arrive, emotions surge and decisions feel urgent. You can sense the shift in your chest and your thoughts become louder. Patience acts like a ballast. It keeps you from bouncing with every headline and rumor. The pain switch is real, and it gets flipped by losses more quickly than by gains. A small drop can feel larger than it is, and fear rises fast. The herd amplifies this effect, nudging people to flock to the exits or chase the latest hotspot. The anchor drags responses toward recent prices, making a temporary wobble feel like a permanent trend. A typical scenario: a stock slips after bad news, and an impatient investor grabs a quick exit. A patient alternative keeps a calm plan intact, riding through the drop and waiting for a more reasonable value to emerge. Understanding these signals helps you separate emotion from money. Your brain is wired to want to buy high on optimism and sell low on fear, which explains why real wealth often accrues to those who stay the course. The goal is to observe momentum and fear without acting on them. You can notice when the herd sways you and choose a different path, one that aligns with your long-term plan rather than the momentary mood. The anchor can be reset by focusing on fundamentals and your target horizon instead of recent swings. Practical steps turn patience into a repeatable habit. Automate regular investments so you don't rely on willpower in the moment. Rebalance on schedule rather than on instinct. Let numbers and a plan guide you, not headlines. Keep a simple rule set. Know your time horizon, know your risk comfort, and commit to not selling out of emotion. Track progress by how long you stay invested, not by how often you chase the latest trend. When volatility rises, remind yourself that the market's upward drift rewards patience, and that the wealth transfer tends to favor those who endure. The more you practice detaching from daily noise, the more you tilt the odds toward the patient, where real gains accumulate over time. You've spent time with these ideas, so here's the core to carry forward. 5 biases that sabotage wealth show up as clear signals if you name them. The herd pulls you to follow what everyone else is doing. The anchor fixes you to a price from the past. The pain switch lights up fear when prices dip, nudging you to sell at the worst moment. Recency bias makes you chase what's new or hot rather than what fits your plan. And overconfidence crowns the belief that you're smarter than the market. Your brain loves action, buying high from greed and selling low from fear, but you can learn to steer instead of be swept along. If you've felt any of these tug, you're not alone. That tug is common, even for people who seem steady on the surface. The good news is you can detach emotion from money with a few simple habits. Pause before you trade, write down a clear decision rule, and measure outcomes against the plan rather than against how you felt in the moment. Create a pre-commitment, like waiting a set time or only acting if the plan is met, and then review results calmly, not as a verdict on your character. If this resonated, consider subscribing for more calm, practical guidance on money psychology. I'd love to hear which bias shows up for you, so drop a comment with a situation you'd like us to unpack together. We'll keep building ideas that fit real life, not hype. In the next videos, we'll put a tiny, repeatable routine in place, one that helps you make steady choices in noisy markets and keeps your money aligned with your long-term goals. Until then, think of money as a tool you guide with a steady hand, not a force that guides you.